Laurus Labs that came out with their numbers yesterday. If you look at the numbers, the revenue has seen an uptick of about 19.4%. The EBITDA margins are the uptick on a year-on-year basis coming at around 27.7% versus 18%, and the profit is higher by about 3.1 times on a year-on-year basis. So let's exactly understand what transpired in the quarter gone by and why such a stellar performance coming in from Laurus Labs. We have Dr. Satyanarayana Chava, who's the founder and the CEO of Laurus Labs, joining us this morning. A very good morning to you, sir. Thank you so much for joining us on ET Now. Firstly, congratulations on your Q4 numbers, because after 3 years of deteriorated earnings, Laurus Labs has ended FY25 on a very strong and a positive note, with about 92% growth on the PAT on a year-on-year basis. If you could help us understand what transpired in FY25 and especially in Q4, and what's the way forward for Laurus Labs?
Good morning. The main reason for very good performance in Q4 for us is our CDMO division performed very well, and also our formulation division also performed very well in Q4. Because of higher margin business did very well. Our gross margin was very good, and also our EBITDA margins were also very, very good. And we expect the CDMO segment will continue to grow in FY26 as well. We have very good projects in place from very big pharma customers. We have active programs in the late stage. We expect this division will continue to do very well. So, as you mentioned, the efforts what we have put in transforming pure ARV-led company to highly focused, diversified CDMO company is giving some results now. And we expect that will be even bigger growth driver in the quarters to come.
So actually, that's what brings me to the next question. Like you mentioned, your CDMO business has really transformed, has done well. If you could help us understand the fact what is happening globally right now, how much do you expect to scale this business up? And if I could add to that, within CDMO, the API business is down about 8%. So you could help us understand the reason for this, and by when would we expect to see some revival on that particular front?
The generic API, we are in a very soft financial year. We expect FY27 is a year where we significantly improve our revenues coming from generic space. Whereas in the formulation space, our capacity expansion for our European partner will be commercially utilized by end of this calendar year. And we expect generic division also will do well in beginning from second half of this financial year.
Right. Also, let's talk about your operating leverage. That has also helped your margins and showing good growth also in this quarter. You spoke about your margins as well. By when do you expect this operating leverage to play the benefit for your margins? And also, if you could help us some guidance on margins for FY26, if you've already done the back of the envelope calculations.
See, in the first half of FY25, we mentioned that H2 FY25 is going to be good, and we will have a 20% EBITDA margin for the entire year, and we did that. And when it comes to FY26, we expect it to be much better than FY25 EBITDA margins because the revenue growth is coming from higher margin business. And also, as we utilize our assets better, positive leverage will come, and we expect these two will contribute significantly to our margin expansion.
Right. I wanted to now put the spotlight especially on your other segments. If you could help us understand what sort of growth are you penciling in, especially for animal health and crop protection business, especially from this FY26 or FY26 end onwards?
Our majority growth driver in CDMO is going to be human health, followed by animal health. Animal health, we expect to complete all validations by end of this financial year. And FY27 is going to be the first year of most of the products going commercial. And we expect significant traction in our animal health business in FY26. When it comes to crop production ingredients, we need one more year to give a much broader guidance. Our facility is operational in Q4, and we delivered one ingredient there. and we are doing another crop protection chemical in FY26, and we have visibility to do one more in FY26. So that division will gain traction the next year probably, whereas as I mentioned, our focus and growth will come from human health CDMO.
All right. Good morning, Mr. Chava. This is Shrishti also joining in. But let me just touch upon your capex, because your company has invested around 3,200 crores in the last 3 years. But these initiatives are yet to yield significant contribution. They yet to contribute in a significant manner. And also currently, they are putting some bit of a pressure in the margins. So from when can we expect a meaningful contribution from these investments, and what's the outlook on the margin trajectory?
See, we expect FY26, we should be able to utilize these assets for commercial supplies. Once we start utilizing these assets for commercial supplies, and we expect our asset turnover also should go up well above 1. And once we do go asset turnover ratios above 1, we have done earlier 1.2 asset turnover ratio. Hopefully, we'll get there. Once we get there, we have invested 3,000 crores in CDMO alone in the last 3-4 years, and we continue to invest. So we have a very good pipeline from very big pharma partners, and we expect to have a very good revenue growth coming from those molecules in FY26.
Sir, I wanted to understand about your capex even more, because you've said that you're making additional 1,000 crore rupees capex in FY26. If you talk about the analysts on the street, they have reservations regarding the capital allocation policy, believe a more prudent strategy could enhance your overall profitability and return ratios. So what would be your response to that, the ones that are actually reading into these numbers?
No, everybody expects India will do very well in CDMO. Everybody says opportunities are billions of dollars. If we don't invest, how will we be able to capture those? So, no big pharma will come and look at a company and say, give me I'll put capex. Nobody is going to give projects. We did a very challenging decision to put capex ahead of requirement, and that is helping us to get to win big projects. And we are very confident what we have invested earlier is going to help us. And at least right now, what capex we are committing FY26 and onwards is not in without knowing what we are going to make. At least we know what we are going to make, which product, which customer, and all. So there is more visibility, more clarity when we put money on the ground right.
The other one that a lot of analysts have also highlighted is the fact that you've not provided any quantitative guidance for FY26 when you talk about your revenue growth expectations. Would you like to guide or give a number to the street who are anticipating and waiting to hear from you how you expect the year to pan out, at least FY26? Because FY25 was a great year for you.
No, earlier we did guidance and we didn't achieve that. So we are very cautious, not giving guidance. But we can give you a qualitative one. Our EBITDA margins will be much better than FY25. That is very good. And then we are saying our asset turnover ratio will go up. So we have capex on ground, and we have products right now. We have customers willing to give more business. I think that our efforts to diversify the company from pure ARV led to diversified is giving fruits, and we're very happy the way we are right now. And we are also very happy we did a lot of capex previously that is helping us to gain traction from our partners.
Live. We are live. All right, Mr. Chava, we let you go on that note. Thank you so much for taking the time out and speaking with us this morning.
Thank you.
If you like this video, then like, share and subscribe to ET Now.